And I hope you bear with me with this talk. This is the first time I've given it, and I've just pulled it together. But I think it's something that is important for entrepreneurs to keep in mind. So anyway, I'll start with a story. I have a friend who's an attorney, and he does a lot of legal formation work for venture funds. So as you can imagine, he's quite busy. And over the summer, he gave me this incredulous look and said, he's like, I don't know how long this can keep going. I mean, how many more venture funds could I possibly work on? And I said, I don't think they'll all survive, but I think that we're just getting started. Now, that may sound contrarian to many of you, particularly because we're in a very overheated market. It feels like there's just way too many funds out there. And some people are, let me see, okay. I know how to work a computer, I think. All right, I'll do it that way. Okay, I'll do it this way. So this is an article that a friend of mine wrote, Paul Martino from Bullpen, and this is pretty recent. And he writes about a micro VC shakeout, and he recalls the days of the internet bubble circa 2000, when there were about 4,000 venture funds that were formed, or several thousand venture funds formed, only to see 10% of those existing today. And you've probably seen a lot of stories about the rise of zombie funds. I don't like zombie faces, so I had to look at this PowerPoint a lot, so I kind of circled it. My husband thought that was kind of silly, but I actually didn't like looking at the zombie face. But anyway, so the rise of zombie funds, and those are funds that are active. There are many that have emerged over the last 5 years. They'll be active, but they just won't, they'll be around, but they won't be active, and they won't be active because they just don't have the returns to go out there and raise new funds. So they will exist. And I think that we will see a shakeout. But I think we're also going to see a number of new venture funds. And so the net of that is actually a net positive of funds out there. So what I want to talk about is the expansion of venture funds, but also at the same time, the expansion of the ownership of US households owning private companies. And what this means for startups and entrepreneurs, and how to think about the financial landscape given this perspective. So let's start with the expansion of US households investing in startups. How many here own public stocks, either directly or indirectly? These are public stocks. It's quite common. How many own private stocks, startups? Okay, here you would have a little bit more, but if you were in Kansas or somewhere, or Idaho, you probably wouldn't have access to a lot of startups. But I think that's going to change. And the reason I think that's going to change is because I see a lot of similarities between what's happening in the private sector and what happened in the public markets circa 1980s. Who was around during 1980s? Who was born? Okay, well, let's go back to the 80s. And what was going on? Well, Ronald Reagan was president. It was a decade of bad hair and bad fashion. The basketball shorts were definitely way too short for my liking. And the mobile entertainment, Sony, was just invented. If I gave that Walkman to my teenagers, they would absolutely be shocked and say, this is supposed to keep me entertained. And so, but that was what was happening in the 80s. But also, something else was happening in the 80s. Basically, it was a start of a bull market. And it was the start of an 18-year bull market, actually. And what would happen at that time, between 1980 and 1999, is you would start seeing the expansion of ownership by US households owning these stocks. Basically, what was happening was a democratization of the public stock market. Heretofore, or prior to the 80s, owning public stocks, sorry, where I need technical help. Owning public stocks actually was confined to the wealthy. So you had to be really rich to own public stocks. But what was happening in the 1980s is that was changing. Now, more and more of the average investor was owning a piece of the stock market. And if you look at what was going on with mutual funds, you could see, I estimate in 1980s, circa 80s, there was about 400 to 500 mutual funds. And during that bull market, it actually quadrupled to about 8,000 mutual funds. And you can see, actually, 1949 is quite surprising, because actually there was only 75 mutual funds. I mean, it's hard to believe it was that small. And then you can also see what happened during this bull market was you saw that the assets under management actually grew 1,000%. That was partly due to because of the increase in the stock prices, but that was also due to the more contributions from more households getting into the game, and that's because you had a lot of these mutual funds forming. So what happened in that period was you started off with 17% of US households owning stock. That doubled to 35% by 1999. And in fact, that would go up to 50% today. And so you could see how it grew over the last 50 years. You could see in 1950, that's actually 1949, it was only 4%. I mean, it's hard to believe that only 4% of US households actually owned US stocks, public stocks. And what was going on? And why did this happen? Well, basically, high returns, sort of a siren song, right? Because it's very attractive. You had provocative headlines. And this is something that came out sort of end of 1970s. It basically by a brokerage stockbroker said it's time to grab the bull by the horns. It's very compelling. We had not low interest rates, but we had declining interest rates. So it made money easier. Also, it made the stock market look far more attractive. You had the explosion of funds that I mentioned, the quadrupling of all those mutual funds. You had improvements in infrastructure. So what was going on in the 80s? You had the automations of the stock certificates. You had automation of data. So that meant that there was more information out there for investors to trade on. And you had the advent of brokerage, discount brokers. So that means the average investor could come in and open up a brokerage account. And you had changes in government policies, like the creation of the IRA, the individual retirement account, and the government encouraging you to take your retirement savings and putting them into a mutual fund. So I see a lot of these same macro tailwinds in the private sector. So today it's about 0.001% of US households probably own equity in a startup. It's about $156 billion of assets under management. And I see both those numbers growing. Why? Well, we're in a bull market, and it's very compelling. Everybody here is trying to get in the game, or everybody next door who are investors, they're all trying to get into the game. They're all creating funds. We have nearly zero interest rates, so this makes our asset class very attractive. We're seeing an explosion of funds. And again, like what happened with mutual funds, the explosion of these funds makes it cheaper to get into the market because these funds allow you to diversify. It also makes it less risky, right? Because you have a fund manager who can manage your fund, and you can go in and invest through them. You have improvements in infrastructure. So you have all these crowdfunding platforms that lower the cost for you to get involved. Heretofore, you had to have $1 million to invest in a VC fund and allow them so they could make investments for you. Now you can put in as little as $2,500 to make an investment into one of these funds. They don't call it funds, let's call it an institutional portfolio. A fund that's managed by a steward. And you have changes in government policy. So probably the biggest change was with the Jobs Act in 2012, where now a private company can have 2,000 shareholders versus 500. And that's why you're seeing a number of companies staying private, because they can. They don't have to file to go public if they have 501 shareholders. And the other thing that's coming around the corner, January 1st, Title III of Jobs Act. How many people here know about Title III? So the Title III, as part of the Jobs Act, allows the average investor to, allows the average investor to invest in private equities or the startups for as little as $100. And there's supposed to be a vote on that probably sometime this month. So all of these act as tailwinds for more and more people getting into the startup game. And we're already seeing it happen. We're already seeing tons of money moving in the sector, moving in the private sector. I mean, look at Just Fab, look at Adam. He could have gone public, but he decided not to. But he's raising hundreds of millions of dollars in the private sector. If you look at what happened in 2015, 300 startups already raised $100 million. 12 of them already raised over $500 million. It used to be the case that you would go to the public markets to raise that. Amazon raised $54 million in the public markets. eBay, $64 million. OpenTable, $60 million. But now they don't have to go public because it's available and accessible in the private markets. So, what does this mean for entrepreneurs? So I think what it means is that startup capital, firstly, is more abundant. That's obvious. Maybe even startup fundraising becomes easier. For instance, do you remember 2011, 2012, when everyone was talking about the Series A crunch and how all these seed companies were going to fall into this abyss and would not be able to cross the chasm to get to a Series A? Well, what happened? You had this emergence of post-seed funds, and we have an event actually called Post-Seed, and we partner with Bullpen Capital, which is probably a leader in that space, if you will, and they started in 2011. There were about 20 post-seed venture funds, and now my friend Paul Martino counts probably 200. So there's going to be a lot more funds. So if you think there's going to be a crunch, don't worry about it. I have a feeling there's going to be a lot more funds that are going to come in to fill that void. I think there's going to be a lot more specialized funds. We've already seen vertical funds. You've had fintech, you've had healthcare, but now we're seeing even more granular funds like skincare, just skincare-focused funds. And even Snoop Dogg has his cannabis fund, right? I mean, everything is getting so specialized. There's just money everywhere, and the good news for you is that you can actually find fashion funds, right? Just find experts in the field that you like. I think that we're actually going to see local funds. So localized funds where only you're going to be investing in your local businesses. Because remember, this is opening up to Title III to the average investor. You can imagine a world where you do have local funds focusing on just funding your local business and having the residents in that area owning a piece of that restaurant or the bagel shop. I think what's happening now, and I said it earlier today, I do think that the startup tech industry is really maturing. It's so hard sometimes to look at companies because they're so good at telling stories these days. I knew that was going to happen. They're such great storytellers, and you have to be because you have to sell your vision. But it makes it really hard for investors to know what to invest in, and so they're going to invest in everyone, right? Money is available, and that just means a saturation of all these ideas. And you heard Jeremy Liu say that there's a lot of everything out there. So if there's a saturation, what does that mean? It just means that it's just very competitive. And I think, and I've been trying to think about how this would change the IPO mentality, but if there is all the money in the private sector, how would you think of an exit? Do you even think of an exit? Does that matter anymore, or does that get really fuzzy? And I'm not sure, but I think the mentality around the IPO exit does change. And so what does this all mean then? If this is what happens for startups, what does this mean, this abundance of capital and this saturation and competitive landscape? Okay, this is what I've been working on, so hopefully it makes sense. So I think we start thinking long term. And I think that's a good thing. Well, what do I mean? So what I'm proposing here is that there's going to be an abundance of capital, right? So think about what happens when you have abundance of anything. Abundance of money, capital, happiness, love, food, water. When you have that, For instance, if you go to a party and they have abundance, or you go to an event and there's an abundance of water bottles and water and drinks, well, you don't walk out of the event filling your pockets with bottles of water and food and drinks, because you know when you go home you'll have it, or you'll go to the store if you're hungry. And that is a good attitude, and I'm so sorry about this. Uh-oh. Adam, keep this in mind. This might happen to you. It's a good way to think, because it's a good. I'm sorry. You wouldn't be stuffing your pockets or your bags with bottles of water because you know that it's already readily available. And if you think about it, stuffing your pockets and your bags with a bottle of water is sort of short-term thinking, right? It's short-term survival tactics versus long-term value creation. We were here to create. So Jack London has a great saying that he says that the purpose of man is to live, not exist. And these short-term survival tactics really just allow you to exist, but not to live, right? Living is a long-term thinking goal. So you think about it and apply that to sort of capital, abundance of capital. Maybe we would actually just take what we need because we know it's going to be there if we do well. And I think that's actually a good way to think about it, because there's a lot of people, a lot of investors, not many, but some investors will say, take what you can. A lot of the investors in that panel this morning said, they really don't think you should take as much money as you can, and that's good, because I think everybody's getting wiser about what could happen when you have too much money. But what can happen when you have too much money? I mean, you're forced to spend it. You might not think about it consciously, but you're forced to spend it. Either your VCs want you to spend it because you have it, and now you have to meet certain goals, or maybe your senior managers want you to buy, that new $500 ergonomic chair because you can. You have it, and so you need to spend it. And probably one of the biggest mistakes I see companies doing biggest reasons I see companies dying is because they're overspending. So just take what you need. In an environment when you have an abundance of capital, I think you can just take what you need. The other thing the other point in regards to thinking long-term is when you think long-term and not short-term, you think about what you passionately want to do. I mean, if it's long-term, you're thinking, God, I'm going to want to do this for 15, 20 years. I better like it. And sometimes that's not the mentality we have in the startup culture, which is, I'll do this and I'll flip the company. I'll do this for 5 years and then I'll sell it. But no, I think because it's going to be so competitive, because you have to make a business, you have to start thinking long-term and passionately, and think about what you passionately want to do. And finally, I think you mature faster. So remember I said it was going to be very competitive. And so what does that mean? Well, you have to be a business faster. And I like to think of local businesses when they open up. Sure, maybe some of them aren't the best managers, but because it's such a competitive environment, sometimes they actually mature a lot faster than startups do. At least they have that mentality. When you open up your local nail salon or bagel shop, you're not thinking, okay, I gotta get headlines. Okay, I gotta get those vanity metrics, and I can raise the next fund. No, you're thinking about your economic model. You're thinking long-term. This is what I'm gonna do, and so I have to think about how to make it a business. And I think you actually won't have a choice. I think if the money is going to be abundant, particularly in the early stages, you won't have a choice but to have that traction, because you just won't be able to there's just gonna be too many of you. So that's the good news and the bad news, and that's my talk. I hope you guys I think we're in a world where great ideas are going to be funded, and I'm excited to see that. And we're also moving into a world where entrepreneurs are going to be smarter, I hope, and thinking about building solid businesses for the long term. That's my talk.